Hello, friends. Welcome to Nirmal. I'm Piyush Jain, and as a part of our multiple budget series conversations, today we are bringing to you a conversation which is centered around economy, what the budget actually has given us from the perspective of fine print on fiscal deficit numbers, borrowing numbers, their overall investment capital outlay, what this implies again for the bond market, for the economy, for the GDP growth. And for decoding all of this, we should be talking to an expert. And for that, let me welcome on the show Mr. Madan Sabnavis, Chief Economist, Bank of Baroda. Madan sir, welcome to the show. As always,
Yeah,
it's
good
always
afternoon.
talking to you.
Thanks for
And
having me here. Yeah.
so let's first start from the budget perspective. My first question to you would be, what actually would be your first sort of takeaways from the budget? Were you happy overall that the government was able to meet the fiscal deficit target, or actually slightly dissatisfied that they could have done the better? What would be your first feeling?
No, I think on the whole, Piyush, I felt that the budget was more to my expectations uh, because I felt that the primary need was that since we had inflated the budget ever since the pandemic came in, there was requirement for us to go back along the fiscal prudence path. So they have looked at 4.5% in 25-26. And now that the fiscal deficit ratio has been retained at 6.4% for 22-23, it was quite appropriate that they have rolled it back by 0.5%. So I think this is a rather slow start which we have done for rolling back on the fiscal deficit. But given the fact that we have the next 2 years where we have to do another 1.4% to get to the 4.5% number, I think this is a good start made. Because I think the budget also keeps in mind the fact that the overall economic growth is going to be slower in 23-24, both in real terms as well as nominal terms, because the nominal GDP number is what is used when projections are made on the tax revenue side.
Yes, and I was looking that the calculation was being done roughly around 10-11%. Was that number realistic to you? That number was conservative? Because many times we have seen in the last budgets, the numbers are far more aggressive and they get toned down when the revised estimates start coming down. But were these numbers conservative?
Yeah, I think the number is definitely on the conservative side because there could be a slight upside. But I think in these kind of uncertain times, it always makes sense to be conservative because it's better to have a positive surprise rather than a negative surprise. So I think, given the fact that I think there is definitely an upside in terms of overall growth prospects, which would also include that inflation will not be as low as 4.5%, which has been implicitly made in this number of 10.5%, which is assumed. We could be looking at a number of around 11.5%. And that additional 1 percentage will probably give you some buoyancy in terms of both the fiscal ratios as well as in terms of tax collection. So last year, if you remember, one of the reasons why our GST collections were very buoyant, it was also because of high inflation, which did push up the overall GDP number, means overall nominal consumption rose at a much more accelerated pace, which is what really led to higher GST collections. So there could be a slight uptick out here. So I think, but playing conservative always makes sense in these uncertain times. So therefore, I would go along with this assumption made by the government.
What is your own understanding right now? Where are we right now? A declining wholesale inflation, or we are also seeing a declining rural inflation? Is it a more about decline in the sort of industrial demand, or you're also seeing a slowdown in the consumption capacity also?
See, there are two parts to it. One, if you're looking at inflation, I think numerically inflation is trending downwards. And that will be a positive factor because most of the policies, especially the RBI policy, is contingent on just looking at that headline inflation number and then taking a decision about what to do with interest rates. But if you look at the internals of inflation, I think we get a different picture. When we look at WPI, definitely the prices have cooled down because it's a producer's price index and it's influenced a lot by global factors. And since global commodity prices have tended to cool in the last 1 year or so, I think there has been a tendency for those prices to come down. But if I look at consumer price inflation, I think a large part of it is being driven by food prices. And as of now, I think food prices are stable. Or what we're looking at inflation, which is the change in prices, has been of a lower magnitude. But one can't really see how that's going to behave because even though the Rabi harvest is going to start very soon, one doesn't really know as to how it will finally turn out. But this said, I think we should also look at the core inflation. I think as economists, we are concerned about core inflation, which is non-food and non-fuel inflation. This has tended to be rigid in the region of around 6%. And given the fact that when you read the corporate investor reports of various companies, I mean, the investor presentations, even today, I think lots of companies are talking in terms of high input costs and about being in the process of passing on these higher costs to the consumer, which means this all falls in the realm of core inflation. So therefore, I think there is still an upside potential to core inflation. So while headline inflation numbers could be trending towards a 5% number if we're talking of CPI, and maybe for WPI, we could also have a number as low as 2 or 3% for 23-24. Given the fact that we've had double-digit numbers for most of 22-23, the base effect also would help to bring down inflation. That will be the picture on inflation. In terms of consumption, I think there's been a lot of pent-up consumption, which manifested in the form of higher GST collections in 22-23. I'm not quite sure if this is the same acceleration will be maintained. So I think that's one of the reasons why, if you look at the budget, if you're looking at overall tax collections, they're talking of growth equivalent to that of your GDP. They're not really talking of a number of 15-16%, which was the case in 22-23. Because this pent-up demand, as well as high inflation, has contributed to nominal collections and taxes. But in the current year, with inflation coming down and also consumers suddenly realizing that their purchasing power has come down and the incomes are not increased commensurately, there could be a tendency for kind of rollback in terms of consumption. So therefore, I think consumption is something which will definitely grow at a lower pace in 23-24.
A very interesting point and important point. And this is where I think our viewers would also be thinking that if the government is already budgeting it, and we have been hearing it globally also, everybody is expecting that as we move towards the first quarter, then second, then third quarter of this calendar year, there is going to be an increasing sort of slowdown, which is going to happen. See, and I think the budget is also just telling like that, as you're just pointing out. From that aspect, was it a prudent strategy to really go for very high capital outlay, or government should have actually put more money into the hands of consumers? What's your takeaway?
Yeah, I think that's a very subtle thing which the government has done because they haven't really given away too much in terms of tax revenue, even though the full feel good factor is there because of the savings scheme introduced, or in terms of the tax rates being rejiggled that is provided you go by the new scheme. But I think what they've concentrated more on is expenditure, and here I think they have leveraged the fact that what the economic survey said that the worst is behind us and the Indian economy is back to normal, which really means that they don't have to give the same kind of relief which was provided in the last 2-3 years. So therefore, there have been cutbacks on subsidies. There have been cutbacks in terms of the Nirega allocation, and one could say that a large part of this has actually been used to fund incremental capital expenditure. So I think that's what's been the major achievement of the budget. That while it's tightly knit, lots of constraints which are there, conservative estimates in terms of revenue, but they've made the expenditure work better. So I think that's where we need to commend the people who have formulated this budget, because I'm not saying that the capital expenditure is a panacea for us and the economy is going to grow at great pace, going to create great jobs and all that. That's definitely not going to happen. That's within the purview of the private sector. But what this particular budget does is that to the extent that the government keeps chipping away at investment, that is through the capex, I think as long as that keeps ticking, that will be a good thing for economic prospects.
From the perspective of actually what we talked about, you just pointed out how basically you're looking at a sort of a slowing down scenario. From your perspective, has the government done a right job in terms of putting up a larger sort of investment outlay?
Yeah, I think, the government is aware of the fact that the economy is going to slow down in the current financial year. And while there are talks of private sector investment picking up, I think it's more sector specific. It's definitely not broad based. So under these conditions, the way I look at the budget is that the government is trying to make sure that the money spent works in a better manner. So how do you do that? There has been a rationalization of expenditures. There has been certain cuts which have been invoked in terms of fertilizer and food subsidy. And here too, it has not gone back to the normal level. They have just sort of rolled it back from the 22-23 level, because we have seen that conditions were quite different, which necessitated more subsidies being given on fertilizers, because international prices had gone up. Food subsidy had gone up because the free food program had been kept on for a longer period of time. So now that we are getting out of the free food system, we are also realized that that fertilizer prices have come down, which means that the necessity of having these kind of volumes of subsidies is not really required. The government seems to be channeling these amounts to capital expenditure. So that's where we're seeing investments being made in the roads and railway sector primarily. And I think the advantage here is that these two particular sectors have very strong backward linkages with the rest of the economy. Of course, it doesn't mean that things are going to change radically, but to the extent that budget, through its expenditure, is able to influence investment and growth, I think the right thing has been done.
So, sir, you were talking about the sort of slowing inflation, and I now actually want to move away from the towards the bond market perspective here. We saw a good net borrowing number being announced and also gross borrowing number announced. I think the bond yields showed us that they took this in good strides because the fiscal deficit numbers were in control versus the rising tax collections. So, what is your view from the perspective of borrowing program of the government?
See, the borrowing program of the government has gets linked automatically to the fiscal deficit number. So what the government has done is that it's kept the gross borrowing program, the net borrowing program fairly stable, so that there's not any untoward pressure on liquidity in the market. And they have, of course, taken recourse to the Small Savings Fund (NSSF) to make do with whatever is required to balance this difference between market borrowings and the fiscal deficit. So I think this is good news for the market because today we're in a situation where liquidity is near neutral. When I say near neutral, it means that the surplus liquidity which was in the system of around 6 to 7 lakh crores at some point of time last year in 2022 has now actually whittled down to almost nil. So we are just on balance. We don't even have a 1 lakh crores of surplus. So in this kind of situation where deposit growth has lagged credit growth, there was always this apprehension that if the government comes up with a large borrowing program, it would necessarily lead to pressure on liquidity and push up bond yields. So that's one of the reasons why we have seen that the bond yields had started creeping upwards post economic survey being announced and just before the budget was announced. But as the fiscal deficit numbers came out, the borrowing program was revealed. I think the market has taken a lot of comfort that things are not going to be bad. Things are going to be largely stable. So I think that's been a very a good move by the government to control the fiscal deficit and also ensure that the onus doesn't fall on the borrowing program, but it's on the market and seeking greater recourse to the small savings fund.
Right, and from that perspective, do you think this is going to provide some relief to the short-term debt market because that has been trading at very high levels since some time?
No, the way I've looked at it is that long-term debt gets priced based on factors like what we're talking of, the government debt borrowing program. Whereas when you're talking of short-term debt, short-term securities, that will be driven more by immediate liquidity situation. And as long as we have the what you call, we see that your growth in credit, growth in deposits, there's some anomaly out there, there would be a tendency for yields to go up. So therefore, if I'm not mistaken, even yesterday when we had the T-bill auctions, the cutoffs were still very high. They hadn't really come down. So I think there will be a distinction between short-term and long-term bonds. So for all practical purposes, I think it could be, I mean, the spread between the two could be getting narrowed. Hopefully not too much, but we'll have to wait to see what the RBI has got to say, what the RBI will probably do in order to do something on the liquidity front to ensure that the short-term yields cool down.
Right. And from the perspective, I'm just taking a sort of a step away from what we're talking right now. I'll come back to this discussion again. And I am just going into agriculture because a lot of investment into storage capacities, also port linkages, a lot of basically has been announced in the budget. How the fine print happens, what is being linked to state schemes or already existing capacities is that something I think we'll hear later. But is that something where you think there's a long-term sort of food inflation or better productivity, which is actually getting incorporated into the planning?
No, actually, we'll again separate the two. I think when we're talking in terms of overall farm production, that will be based on factors such as area under coverage, area under cropping, how the monsoons fare, access to irrigation, and overall we're talking in terms of productivity levels going up. Now, whatever is being done on the logistics side by the center and also partly by the states, because agriculture is basically a state subject, so states have a bigger role to play. I think that only helps in improving the transmission of goods from the farm to the mandi, that is finally to the consumer. So, because we see there are lots of wastages which take place in a lot of this agricultural crop which comes out. So, I think what the government is trying to plug at is basically on the logistics side to make sure that you have more efficiency out here. But the deeper problem actually is how do we actually make sure that the farmers change the cropping pattern, move to more remunerative crops, they grow less of rice and wheat where the MSP is there, because those crops are also quite dangerous when it comes to the water table levels, which are getting depleted on account of greater sowing of rice and wheat because of the backstop facility there in the form of procurement by the Food Corporation of India. So that's of course the more long-term goal, because the fact what we see here is that okay, today they're talking a lot about millets, but will farmers actually switch from wheat to millets? Okay, will they actually move from
Very less
pulses?
likely.
That can actually create distortions in the overall crop matrix.
Yeah, but it's very less likely, right? Because the crop productivity in millets actually is very low compared to wheat.
Absolutely. So that's low. So I think these are good announcements to make. These are good nudges to make. But finally, I think, and I think just like how we don't change a job just because we're not happy where we're working, a farmer's firm just shift from wheat or from pulses to millets merely because the budget has something for millets. So at the end of the
Yeah.
day, it's the market conditions, the cost of cultivation, and your logistics, which is air transportation. Were they able to go to the mandi? You have buyers for it. I think when we were as a deviation, I would say when we had those farm laws, they were really good laws. Hopefully, they will come in at some point of time. But I think the entire marketing structure needs to improve so that one part is what you grow, the second part is about the marketing. I think all these ends need to be tied up to have a robust agricultural system.
I'm just referring to some numbers here and coming back to our economic discussion. Farm exports is one topic which the government has been trying to do, but now I'm coming back to holistic export numbers here. Third quarter FY23 exports declined by almost 9%, 8.6% YOY, 9% quarter on quarter. We're already seeing some slowdown in US and Europe. The numbers are telling in US. From that aspect, are these numbers already sort of incorporating the sort of export slowdown overall? What's your assessment from a perspective of total calculations on the exports?
Yeah, definitely. When we're talking in terms of a slowdown in the West, maybe a recession in certain countries where there's negative growth, this will necessarily mean that the demand for imports would come down, which means that our exports are going to get affected. It's going to affect exports throughout the world. The positive part of the story is that since India is a domestic oriented economy, the kind of harm which is caused is not as sharp as what it would be there for, say, the East Asian markets, where they are export oriented. Maybe 70 to 80% of their GDP actually comes from exports. So they're more likely to be affected than India. But definitely, in terms of our external account, the balance of payments, I think with exports slowing down, imports probably continuing to grow because we are saying that we are growing at more than 6%, which means that demand for imports will continue to increase. There is going to be pressure on the current account deficit. So I think this is what the economic survey had also pointed out that there would be pressure on current account deficit. They haven't given a number, but my sense is that it would remain in the region of around 3%, maybe slightly lower if we're looking at a number slightly higher for 22-23. But that would definitely mean that the currency could also be under pressure because the capital flows would have an important role to play. And depending upon how the recession behaves and what central banks do, overseas central banks do, that would also sort of have a bearing on what foreign investors do. Do they continue looking at Asian markets or do they continue to invest in their own country? So that will be a big question mark out there. We'll have to wait and see as the year progresses and what the central banks overseas are doing as to how exactly these flows will be. But definitely the external account gets affected on account of a recession in the West, starting with exports coming up.
Right. And from that aspect, my sort of question to you would be, um, we know that in US people are still expecting hike in interest rates, but they are also expecting a cut in interest rates in the second half of the calendar year. So these are two very divergent expectations which are getting built up there. What are you expecting from our central bank right now? More interest rate hikes, or that is what we got, and now uh, we are more likely going to be in a sort of watch mode?
Okay. Actually, before the economic survey was announced, I would have said with confidence that there would be another 25 basis point hike in the repo rate so that we come to around 6.5%. So, if I look at the OIS rates, I think they all indicate towards 6.5, 6.6. So, I think 6.5 seems to be a fairly a reasonable number to expect. The last rate hike for in this particular cycle. So, and then probably a long pause because you need to see how the inflation number works out and you get a clear picture only towards the second half of the year when you see what happens to the Kharif harvest, what happens to global prices, crude oil, so on and so forth. But I think the kind of commentary which has come from the point of view of the economic survey, where they did talk about inflation cooling down, coming down to lower levels. Look at the budget, which is making an assumption of inflation in the region of around 4.5%. I'm not quite sure how these two numbers, how these two views would actually go into the minds of some of the MPC members when they're discussing. So I would say as of today, maybe 60% possibility of a 25 basis point hike in interest rates and 40% pause. I still think that there would be another hike and then a pause, but I won't be surprised if the RBI decides this time not to touch interest rates.
Well, that should be, I think, a factor which we'll keep watching on the interest rates. Moving towards rounding up our entire conversation, sir, as a holistic verdict on the budget from an eminent economist like you, what would be your takeaways?
See, my takeaway would be that the government is following the path of fiscal prudence, which is most important. And we should remember that even as the fiscal deficit ratio keeps coming down, I'm still concerned about the debt to GDP ratio, which is around 56%. So I think the FRBN spoke of an ideal number of 40%. We're very far from it. And even as we roll this number back to 4.5, we finally have to look at 3% number. If I don't see that kind of momentum in my GDP number, I think our ratio will still continue to be terribly skewed. So I think that's the major concern because as our debt keeps building up, even though the fiscal deficit is 5.9%, we're still borrowing around 11 lakh crores in net terms. And every time if I'm going to keep adding 11 lakh crores, it has to be serviced. And if you see the alarming part is my interest payments have actually crossed 10 lakh crores. It means out of a budget of 45 lakh crores, I'm spending 10 lakh crores just as interest payments. So I think debt servicing is a concern. So I think the faster we get towards the 4.5 and the 3% mark, it will be good. Now, within this particular constraint, that since the government is very cognizant of what I'm saying, I think they have done fairly well in terms of managing the expenditure because we all feel that since the private sector is not investing, the government should continue to invest. So whatever can be done within the realm of the budget has really been done. We need to see how the states actually follow because the states have been a bit slow on spending because they're more worried about the fiscal deficit numbers. So they have not been as aggressive as the central government is spending. But ideally, I think if the states are also able to contribute normally to comparable numbers, and I'm talking of 10 lakh crores, they should be spending close to 8 to 9 lakh crores in the next year. Then I think that will be good for the economy, considering that the private sector is still quite slow and it's more based on certain sectors. So on the whole, I think it's a fairly well balanced budget. And since they haven't given to populism, given the fact that this is a pre-election year, I think that's a major takeaway. It was quite a bold move to actually cut down on subsidies because in the pre-election year, one would not have expected them to be so drastic. But they have done it in a very convincing manner so that there hasn't been any alarm which has been sounded. So I think we could be expecting similar kind of moves in the coming budgets. And but if the focus will be on fiscal prudence as well as capital expenditure.
Well, that was an in-depth takeaway. Madan sir, as always, it was really a lovely talking to you, and we got a lot of insights on the budget.
Thanks a lot, Nish.
And dear viewers, with that, it's a wrap on this show. Thank you for watching us.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.